Hi everyone, I'm Victor Werney. I'm from Cboe Markets. I cover exchange-traded fund listings across North America for Cboe. At Cboe, we operate 26 markets and exchanges across the globe, with 5 of those actually being ETF listing venues. We have ETF listing venues here in the United States, Canada, UK, Netherlands, and Australia. Across the globe, we list over 1,000 ETFs from 125 unique asset managers. I'll turn it over to the rest of the panel to introduce themselves and their firms.
Glad to be here. My name is Jeremy Eisenberg. I'm an ETF specialist at Alliance Bernstein. Can you hear me? At Alliance Bernstein. AB is a global asset manager with over $700 billion in AUM. We launched our active ETF suite at the end of. Gotcha. Thanks. We launched our active ETF suite in September of 2022. Now have 12 ETFs and 1 buffered product.
Thanks. I'm Joe Cusick. I'm from Calmos Investments. We are the 3rd largest alternative 40X fund offerer and provider. We just jumped into the ETF space a little over a year ago with our latest ETF being the principal protected, and right now we have about $37 billion under management, all option-related type offerings.
Hi, I'm Trent Houston. I lead product strategy at PGIM, which is the investment management arm of Prudential. We've been managing ETFs since 2018. Our largest ETF, Pulse, was launched that year. It's about $6.5 billion. As a firm, we manage a little over $1 trillion at PGIM. We entered the defined outcome space this year. By the end of, the start of next month, we'll have 24 buffer products in the market and a couple of laddered products coming in the middle of June as well. I'm very excited about the growth in this space.
Is this working? There we go. I'm Aiden O'Hara. I do institutional sales at Pacer ETFs. Pacer is a strategy-driven ETF firm out of Malvern. Been around since 2015. We have 47 different ETFs that we offer, one of which is a suite of buffered strategies, and we manage right around $45 billion.
Awesome. So today we're going to be talking about defined outcome ETFs. I know there's a lot of different flavors and strategies of defined outcome ETFs out there, a lot of definitions for what a defined outcome ETF is. So I'll turn it over to the panel. In the simplest terms, how would each of you classify what is a defined outcome ETF?
I think you're 100% right. There's obviously over 200 now products, so you have to have a pretty broad description of that. I think in its simplest form, defined outcome ETFs they provide a predefined range of outcomes over a set time period.
Yeah, I'd agree. And with not only defined outcome, but then you have buffers, which have a somewhat defined outcome, but there also is exocentric risk outside of that outcome because it's not 100% defined. So you have to understand what you're getting into as well as the trade-offs.
Yeah, I think I'll echo the same points. When we got in this space, we were excited by the opportunity to offer clear and specific outcomes to our clients, and that's the crux of what defined outcome investing is, in our opinion. It's simple, explicit investment experiences over set time frames. For us, we chose the buffer, and I know we'll use these terms a little interchangeably throughout the panel, but with the consistent downside mitigation, if you will, in the buffers, that made the most sense to us in that space. But we thought flexibility is key with any of these products. So for us personally at PGIM, we manage a similar product in the annuity space, and it's a RILA product. And we came out with monthly vintages for our products, given what we learned from how these things tend to work in the annuity space and how key that flexibility is to invest and choose your starting points in these set time frames. So that to me is defined outcome investing. It's simple, it's explicit, and it's those set time frames that you can get your investor experience that you sort of understand going into it.
Yeah, the way that we define, or what kind of we explain in short to advisors when we're talking about defined outcome strategies, is that it's a strategy that gives you a predetermined level of protection on the downside over a defined outcome period within a certain amount of cap or upside cap over that same period. So you get, one for one kind of, I'm sure we'll talk about that, market participation on the upside, and you get a predetermined level of downside protection as well.
Yeah, so this has been a space of the ETF industry that continues to grow and flourish. So looking at the 2024 new launch landscape in the United States, about 25% of new launches this year have been a different flavor of defined outcome, whether it's buffered, target, principal, structured, whatever it may be. It's starting to pick up to become a large portion of the new launch lifecycle in the United States. Overall, these products account for about 50 billion plus in assets under management. And to Jared's point, there's around 200 plus of these products in existence today. So kind of taking a step back, who are the primary users of these products? Why are they using them? And really just a little bit more on that.
Sure. Given the nature of the product, really the end client who would be interested or actually benefit from this is someone who wants to maintain equity exposure while limiting their downside volatility. I think that as the products continue to grow, so too do the client bases that this may actually impact. So I think that is also growing along with the product set.
Yeah, I'd agree. Typically you'd see someone like a retiree, someone that wants that principal protection with equity exposure. But I think also it's, interestingly enough, something that someone's new, the younger generation, because of the fact that we are rolling out products that are actually putting new structures in place almost every month. You can almost see the opportunity that you can trade these, right? Now, obviously there's tax implications, but you're also seeing that with the growth of these, that we can also get the new entrants, and also the active entrant participants that are looking to actively manage these products. I think that's where the opportunity lies as well.
Yeah, there's certainly no shortage of avenues for growth. I mean, Victor just laid out that there's 50 billion plus in these products already. And I think we all sit here and say it's the tip of the iceberg. But in terms of where we're seeing the greatest adoption today, at least from our perspective, and I'm sure the other firms up here are seeing the same thing, it's truly RAs and independent financial advisors are the ones who are using this most right now. But there's obviously room for this to grow into other channels. I think about how popular structured products have been in the wirehouse channel historically, and that seems like a very obvious place where these defined outcome products can fill a need that's a little more liquid, a little cheaper.
Yeah, I'll echo the comment on RIAs and independent broker-dealers, and hopefully, we start to see more adoption on the wirehouse side at some point. But like everyone else on this panel said, I think the end client that they're ultimately using it for are people who are either in retirement or nearing retirement, and the why or how that they're using it, I think varies quite a bit depending on the client. You have some people using it as a fixed income proxy. You have some people using these strategies to hedge against equity market volatility. So, I think that it's kind of a Swiss Army knife type of a strategy, and you see it used in a lot of different ways.
Yeah, and Trent and Joe, that leads into our next question around, could someone easily do this on their own? And overall, has advisor feedback generally been positive around this product set?
Yeah, I can start, and I would say there's obviously a degree of operational complexity in terms of managing these strategies, both from the options layering perspective, but also the trading execution perspective, particularly with regards to the fact that these products are generally done with flex options. So one of the pieces of feedback that I think we receive and maybe resonates most when we talk to advisors in this space is our experience trading flex options. A PM on the PGIM buffer ETFs, for instance, has been using flex options for 30 plus years, and that's not something that the individual investor probably has the same familiarity or experience with, even if they do have familiarity with listed options, right? So that flex options experience tends to be something that kind of separates the institutionalized manager in this regard versus the individual. And then I would say kind of a separate section, but of the advisor feedback that we are getting, concerns the logistics for the advisor themselves in terms of managing one product versus a number of different monthly vintages across their entire book of business. And we think that's certainly valid. And the truth is, we want to make sure you can provide a financial advisor the most solutions to access this type of strategy. We think it's pretty profound, whether it is in individual monthly vintages that may be better suited for a specific client, or a single ticket product that can be better fit into a larger book of business. So those are probably the two pieces of feedback we hear the most. It's just kind of having different solutions, both the individual and the single ticket, as well as sort of the kind of experience that the flex options market brings, or that you have in the flex options market.
Yeah, and if you haven't noticed, I have a lot more gray hair than Kent here. So, and I also came from the different part of the world where I helped start a retail options trading firm called Options Express, and we sold it to Schwab almost over a decade ago, where we believe retail traders could do this, and they can, but it comes down to, and so could advisors. We had an advisory side too, where they could do option-based strategies. The challenges are not only the mechanics of something like a flex option, which is a customized option, but it's also the time consumption, right? It's something that people just as an advisor or as an individual investor, they just don't want to do it. So being able to put it into a package, and then the biggest benefit that I can see in the ETF space and why we see the growth in the ETF space is the tax efficiency. And that's something I know we're going to hit on, but I think that's the number one big thing about this wrapper and where it is starting to get disruptive in spaces that we didn't think it would be, like the insurance space, which we'll talk on a little bit.
Absolutely. And Aiden and Jared, I'll turn to you and ask, what type of market is best for your end clients to kind of purchase these strategies during?
Yeah, I'll go first. I don't know if it's too salesy of an answer to say any type of market environment, but I do believe that. There's a few that kind of stick out. I mentioned these being used as a fixed income proxy. I think in the initial phase, as people started to gather assets in these types of strategies, a lot of people were selling it, or a lot of firms were selling it as a fixed income proxy when you really couldn't get much out of fixed income at that point in time. That's changed a little bit. But the reason that I say any environment is, even like in a rising interest rate environment, you look at last year, 2023, I think it's a great solution in that type of an environment too, if you're using it as a fixed income proxy. So you saw long bonds get hammered last year. A lot of people were suggesting, or a lot of firms were suggesting, that you extend duration at the beginning of the year last year, and then we saw what happened with that. And if you'd use this type of a strategy as a fixed income proxy instead, you could have gotten market participation up to obviously a certain predefined cap over that period. The other obvious one is when equity market volatility picks up. I'm sure we'll go into some of the dynamics on volatility in a moment, but you tend to get higher upside caps in those environments, and it helps to protect on the downside there, so you can take some equity risk off the table in those types of environments as well.
Aiden took the sales pitch, and I'm going to take more of the compliance one. I really do think that it is specific to the individual client, right? The market environment, even when equity markets are roaring and there's not a sign of a potential downturn, that still may be the right product. You could put, it may be the right product for someone who is, for instance, near retirement, or much more concerned with preservation of capital. It really depends more on the client than the market.
I'll give the trader's perspective because I am a PM. The kryptonite for a strategy like this is if interest rates go back down below 2%. Okay? Because then you're looking at one-year paper and it's probably equivalent to. And if you look at the numbers with an option-based strategy, especially whether it's buffer or principally protect, that's where you start to see the returns start to diminish against traditional paper, treasuries. So at the end of the day, if you believe that rates are going to stay well north of 2%, this strategy is going to do better than one-year paper historically. And it's also going to offer opportunities for a better protection of capital than you would see with better liquidity potentially versus other alternatives that would be more traditional.
So it's safe to say, Joe, interest rates really do impact the outcome caps.
Absolutely. I mean, in the last year and a half, you've seen that where 0% interest rates were in play until the last hike was in 23 in July. The bottom line is that you were barely able to get on a buffer protect without having it be an expense, right, a cost. By the time those interest rates flowed through, you were actually getting paid so that you could sell calls, as Kent was saying and everyone else was implying, that you could sell higher out-of-the-money calls, and the puts were way cheaper. So when interest rates go up, calls get more expensive, puts get cheaper. So the structure looked great. Your caps went from 6-7% to 10-12% almost seemingly overnight. Again, rates staying high for longer is going to be a great benefit for structures going forward, right? We're seeing the pricing still holding in through June of 2025 so that you can set up structures going forward. And when they do come off, we're going to come up with creative products that are going to be able to solve that issue and make these puffer protects and principally protects a good solution still.
Fantastic. I know this may sound like more so a remedial question, but I know a lot of times you may get asked, do these products track one for one with the indexes or the ETFs that they're in fact based off of? I open that up to the panel if anyone wants to take that one.
Yeah, I'll start because I do think this is the most important aspect of investor education with regard to these products. When you look at your buffer ETFs or your defined outcome ETFs at a point in time intra-period, it may actually look like these ETFs are failing to provide the investment expectation that you thought you were getting, the investment experience that you were expecting, I should say. And that is just because of the way the options math works. And rest assured, if you do hold these products for the duration of their outcome periods, they will perform as expected. And I'll just use a really quick example of, say you have a 12% cap and a 12% buffer just for symmetry purposes. And halfway through the outcome period, the market's up 7%. Your ETF may only be up 5%, even though that's well within the cap and you think you should be tracking one for one with your reference asset. That's just the way that the options work. They tend to have a lower beta to their reference asset. And I think Joe and others may get into some of the more mechanical reasons for this later. But what will happen over the course of the rest of the outcome period, if your ETF's at 5%, the market's up 7%, that market just holds steady at 7% and ends the outcome period up 7%. Slowly your ETF, despite no market appreciation, is going to move towards that 7% level. I think of it as like a gravitational force that pulls the buffer ETF towards its expected outcome as the options near their expiry. And the same thing happens on the downside. The market's down 7%, your ETF may be down 5% despite having a 12% buffer, right? And you would say, no, I'm not supposed to lose any money in a 12% buffer if the market's only down 7%. Again, as the ETF approaches its outcome period end, that gravitational force is going to pull it back to zero towards what you expect your outcome to be. And over that course of the outcome period, you are going to get what you expect. So educating people to understand how these products work is really a critical component. And yes, over the outcome period, they do track one for one, but intra-period, they may not always look that way. And you just need to understand that. It's not even about being patient necessarily. It's just about having that knowledge going into it.
Yeah, I mean, I'll put it in similar terms where, if you understand an options product, it's made up of one of two things, if not both, extrinsic and intrinsic value, out of the money and in the money value. So the value of money doesn't equate to one immediately when an outcome starts to transpire, right? These options will decay at different rates. The rate of change is going to change as the markets move up and down, as rates change, time passes. A very simplistic way of thinking about it is like if you're in a principal protect and you bought it on day one and you got it right at the price. You should expect in the first quarter that you're going to have about a 25% capture ratio to the up. And then you look at the second quarter and you see that it's still up and you're going to get about a 35%. When you get to the third quarter, you're now in the 50th to 60th percentile of capture. And then by the time you're in the fourth quarter, getting closer to the end of term, you're going to be able to see 70. And then eventually, if you hold the term and it is through that cap, you're going to see that you're going to get 100%. It's that simple. It's just you got to understand what are the components that are in the buffer, right? And what they're actually utilizing it on the upside to set the cap. Once you understand those components, then you're going to understand how that outcome is going to start to price out.
So Trent and Joe, staying on this, what should potential investors consider ahead of transacting in one of these products? Is there a specific time that they should enter one of these strategies?
Yeah, I'll start off. I mean, the obvious one is on day one when it's offered, right? That you try to get that list price and you try to stay within, a few points of what that price is. But then it's also, what are you trying to achieve? Remember, with a lot of these principally protected or buffer protect, you could look at cash and you could say, well, I could leave it in cash, but the outcome of that is that you're going to pay taxes on ordinary income tax on the interest that you have in that vehicle. So basically, you're looking at on rates at 5%, 3.2%. You could look at a buffer protect that just released, and maybe it capped at 9.81 on day one, and maybe it has 8.5. Well, okay, so you could take on 100 plus basis points of risk to the downside, but then be principally protected after that. But if you believe that over the next year, you could have still 7, 8% up, it might be worth taking, a 1%, 1.5% risk to get in this structure, especially going into things like elections, right? Going into uncertain world, macro events and so forth. And obviously, we don't know what's going to happen in the interest rate world. So it could be an interesting proxy.
Yeah, I'll echo what Joe just said. So these products are designed to be entered on day one and held to the outcome period end date, right? That's the way you get the defined outcome in these products, pure and simple. Now, it doesn't mean you have to buy it on the open on the start date, and that's something all of us in the ETF world would probably advise you not to do. And frankly, given the low beta nature of these products, you're probably okay to buy them even a couple of days around the start date, as your market, in a normal market environment, you probably haven't moved that far away from your home base. But over time, you are going to get further and further away from that starting value, and then the outcome you may get in your product isn't necessarily going to be reflective of what you expect if you wait too long, right? So for that reason, it does make sense to kind of think about these starting periods, and it's one of the reasons why we launched monthly buffers, is in order to make sure you have a bunch of those starting periods that you could potentially hit. But to Joe's point, there are opportunities potentially intra-period where you may see the ability to kind of think about resetting your upside or resetting your buffer levels given market environment and overall investor outlooks. And it's worth kind of paying attention. I think that this will increasingly become a component of this market where you may be close to your cap. There might be 3 months left to go in your outcome period, and you might want to reset your buffer. And that's obviously, there's tax implications and things of that nature, but hopefully as this ecosystem grows, you have opportunities to do that. And it may be worthwhile to always be considering that sort of aspect as well, depending on the overall market environment.
Thanks, Trent. Thanks, Joe. So Jared and Aiden, are you seeing a rise in these products being included in model portfolios today now?
Yes. So our buffered product that we launched was actually intended to be model friendly. We wanted to make sure that that was the case. It's an evergreen strategy. I think that one of the barriers to adoption broadly across model providers has been the logistical, kind of nightmare that you may run into with as you continue to onboard clients at different entry points. So we were trying to mitigate, I'd say, that factor by creating rolling 3-month periods, exactly for that reason. And past our product, I think that we're broadly seeing adoption across model providers as well.
Yeah, I would ditto the comments on logistics, and I think that certain firms have put out good solutions to those strategies. We've seen model adoption increase. One of the kind of key areas that I think is worth noting is ETF strategists across the country who manage model portfolios of ETFs for advisors. We've started to see adoption there. Not an area that I would have expected maybe 2 years ago, but they're generally kind of at the forefront of new developments in the ETF industry, and they've started to use them in their portfolios. From like a firm model perspective, I think it might be a little while until you see that adopted at wirehouses and regionals, just because they're kind of limiting access right now. But there's a ton of room for growth there as well, and we've seen interest from kind of smaller, more independent type broker dealers within their firm model portfolios. So there's definitely adoption and interest.
Yeah, distribution is such a major component to the success of an ETF. Outside of model portfolios, how else are you and your firms getting the word out about these types of products?
Media, content. It's amazing. We rolled out 2.5 weeks ago our first 100% principal protected product, and in a week we raised $100 million, which was extremely successful. We were on TV, we were educating, and probably the biggest thing was that we were prepared with information and engagement so that they could actually see how this works They could track it very clearly, meaning not only the advisor, but also their clients. So it was very, we deployed it in such a fashion so that they could consume it and immediately see that it was a solution set for them.
Yeah, I mean, I think these ETFs lend themselves to individual kind of marketing in a way that maybe not all other ETFs do. So to Joe's point, I certainly see that's a tremendous opportunity to raise awareness. I wanted to take a little different approach and maybe give a shout out to the ETF Global people here who have been tremendous partners for us, because one of the things that's so important in this space is having a new set of information available mostly on your own website, right? Because you need to educate people on the remaining caps, the remaining buffers, how much downside you have before the buffer kicks in an up market. There's a lot of components to this, and the ETF Global folks have been tremendous partners to us at PGIM in helping us make sure that we have a compelling website that's easy to navigate, easy to visit, has accurate data on it, and that's an aspect of this market that is really critical given the educational aspect we were talking about earlier in terms of where you might be intra-period. So in addition to just your traditional distribution aspect, I do think it's a critical component of being successful in this space is having that sort of educational aspect as well.
If I could just add one more thing on the data front. Not only is it important to have all of the content ready, but you need to actually go get in front of the right potential buyers, right? And I think that is where we've seen data really come into play here with a constrained amount of resources for distribution and not an unlimited pot of money to kind of spend on marketing. We need to make sure that we're getting in front of the right people, and that has been a huge help. I think we've seen a significant uptrend because of that in our assets.
With 200 plus products and 50 billion plus in AUM, do you believe we just scratched the surface here, or is this just the beginning?
We just scratched the surface, no doubt. 20 years ago, I was involved with the retail options trading community, and that was the fastest growing community that everyone saw. We realized the reason why that was is we were offering them technology that institutions didn't have. Now institutions have it, specifically pension funds. They're adopting this at a pace that where you would have a 24 to 36 month turnaround on a proposal, where it's now 6 months at best, and that's real money. So the fact that now they're adopting ETF structures because of the tax efficiency, that it solves a problem, and that the custodians and the back offices now have the technology to support this type of activity, this right now is where everybody is going, and we can see it with the numbers that we've seen. So I think we just scratched the surface.
I mean, I think all of us up here believe we just scratched the surface on this, or else we wouldn't be sitting on this panel. But in addition to a lot of what Joe just said, and we touched on earlier, there's probably new distribution channels where there haven't been heavy adoption of these products yet. I also think the way these are kind of utilized in portfolios and the way investors may think about these products still has room to evolve. As people get more comfortable with the outcomes and the investment experience that you will get in these products, and they consider it in the context of what some portfolio construction theories have been trying to achieve, like the 60-40 blend, they may ultimately see that in these products you are getting that outcome explicitly, and it is easier for you to kind of build your core portfolio around these products and then allocate around the edges with satellite investments. And obviously we talked in the outcome where this can be really good for people approaching retirees, et cetera, but I think there's a chance that we can really evolve our theories around portfolio construction with these type of products. And that to me is probably the most exciting avenue of growth for these defined outcome and buffer ETFs over the long term.
So there's an obvious avenue of growth, which is that there's limited platform availability for a lot of these types of strategies. I mean, you see primarily RIA, independent broker-dealers that allow onboarding of these strategies. And so I think as it starts to open up, and more firms get more familiar with how they work. There's a lot of assets at some of the biggest wealth management firms in the country where these aren't available yet, and so you'll probably see a lot of flows just from that. But the other kind of area and why I think that this is going to continue to grow is, simple as just thinking about the aging demographics in the United States, right? They're going to be looking for types of strategies that they can utilize in their portfolios that are tax efficient, that give them a certain level of downside protection, and that give them a certain rate of return that they can achieve to be able to retire and live the life that they want. So I think these are great solutions to those problems, and you have a lot of the U.S. is going to be retiring within the next 5, 10, 15 years, and so you'll probably just see more and more adoption there.
Taking a step back from defined outcome ETFs and just looking at overall options-based strategies in the ETF wrapper, do your firms offer options-based strategies in the ETF wrapper outside of defined outcome? How have those strategies fared? Is that a space you're just as bullish on as defined outcome?
Yeah, so we're primarily option-based. So we have offered ones that are along the lines of the Mag 7 and CanQ. We also have offered ones with convertibles, because that's what the cornerstone of Calamos has been in the past. So we do have CVRT, and we see an opportunity there. And we did do an ESG one. That's been a little bit of a challenge for acceptance, but it's slowly but surely. And now with the Principal Protect, I think it's been putting us on the map as being creative in the option space.
Yeah, I'll be completely frank. We have one other options-based product, and it has not been as successful as either its mutual fund counterpart, which has a decent track record of raising assets, nor the defined outcome ETF space as a whole. But I think we believe that the defined outcome and the growth of this market in the ETF side of things can be a catalyzing sort of aspect for options-based strategies in the ETF wrapper. We've obviously seen success in other wrappers. I mentioned the annuities business early on, the mutual fund. It's clear that investors can get comfortable with options-based strategies, and options-based strategies can give you the flexibility to do some interesting and creative things. And I think there's no question that over time, the ETF market will continue to adopt options-based strategies, and hopefully defined outcome ETFs are a great way for people to get comfortable with that.
Awesome. So we'll close out with this question. Looking down the pipe in terms of options-based strategies overall or defined outcome ETF specifically, what exciting innovations or products do each of you see coming down the pipeline in the months or years to come?
Digital assets, crypto. We finally see that the pressure has been put on Washington, by Washington on the SEC. You're starting to see CFTC is starting to make moves, and you're starting to see that the exchanges outside of the CME are making moves. I think that could be the most creative space, both domestically, but also going beyond here in the U.S. and offering opportunities. So I think definitely digital assets in the near future. We're definitely moving forward in it, and we've done some filings in the last week, so we're really excited about that.
I think that the evergreen buffered space, where we currently are playing in, is going to be massive in the future. If you look at flows, the actual individual product flows on 1 year and year-to-date basis, 3 of the top 5 have been in evergreen products, right, for the buffered space. And I think that that is a sign that that type of product has a broader appeal to a number of clients than potentially a more segmented or monthly approach.
So I'll take like a higher level approach to this answer, because it's tough for me to say there's one thing that I think we're most excited about or see driving growth in this space. To the point Jared just made, I think having multiple solutions that allow you to be consultative when you distribute to financial advisors and clients is important. You just need to do what's best for their individual practices, and having as many tools in your toolkit will allow you to do that. But taking a step back, I think the buffer structure, which is what we are focused on at PGIM, is very conducive to a number of different permutations, whether it's underlying reference assets, whether it's the outcomes you can provide to clients, you can, the length of the outcome periods. We've seen a lot of different innovations, and that's the hallmark of the ETF market, right? The ETF market is historically proven to be very innovative, very agile, and I have no reason to think that it won't continue to be conducive to further adaptations in this market as market circumstances and investor demand dictate. So to me, there's just a lot of runway, and that's an exciting aspect of this market.
Yeah, so I was at a RIA conference last week, and one of the main themes, maybe the main theme of the entire conference, was talking about scalability for the financial advisor, how they could make their practices more efficient. And so On our side, the thing that excites us, and we have a buffered fund of funds, which is actually our most popular strategy within our suite of buffered strategies, is single ticker fund of fund type solutions, hopefully, that will be able to come down the pipeline that will make it easier for the financial advisor or the model portfolio manager to be able to take advantage of these types of strategies with a single solution where they don't have to be keeping track of 10 to 12 different positions in their portfolio that have different defined outcome periods or different caps and buffer levels, and track where they are in all those different cycles. And so that's what excites us the most.
A lot of exciting opportunities to come. So thank you to our amazing panelists. We'll be around for questions after the panel if anyone would like to find us. Thank you.